Edgeful made me a countdown video with like they said they got licensing for the like little background music. It's just like elevator kind of music.
Yeah.
Bro, YouTube flagged it and took it down after like 8 streams of using it. YouTube finally flagged it and threw it down.
So yeah, we got to figure out something legit, but we'll figure it out.
Even though they had
Sharing
it
is
clear.
caring. What the hell?
Yeah, it's
No.
crazy.
Not when you're making money off someone else's shit.
Did you guys ever hear about that guy from Cisco? Or Cisco is the rapper, the pop star. He had the Thong Song, which is like a big hit and still is a big hit to this day, gets played in radio stations. So he actually makes very little to no money off of that, and the producer makes all the money on it because he said in that song "Livin' La Vida Loca." And so the producer for "Livin' La Vida Loca" by Ricky Martin, he's getting all of the what's it called? All the royalties. Yeah. So Cisco actually makes like no money from that.
Story? Yeah. Why are you so informed on Cisco and the Thong Song? I just need to understand.
Because I'm all about the Thong Song, baby.
we all have our workout jam. That's obviously his.
That's whenever I go to the gym, I just like play that on repeat the whole time. It's like the same song for 20 times. The Thong Song.
All right, should we do it?
Let's do it. Let's do it.
I'm trying to think of how I'm going to come in right now.
It's already recorded.
What's up, everybody? I know. I'm just like, I'm trying to think of what that first line is going to be. What's up, everybody?
Yeah.
Let's go for it.
What's up, everybody? We are here with the first episode of Investing with the Boys, a Wolf Financial podcast. I'm so excited to kick this off. I have the boys right here with me tonight. Sam Solid, Logical Thesis, and Stock Savvy Shy. How we doing, boys?
Doing great.
Good, doing good.
Excited.
Awesome. Well, I'm excited to get into this conversation, hear what you guys have to share with us. We're going to go ahead and kick this off. I do want to shout out our sponsor, Osprey Funds. Osprey Funds did create the first Solana trust as well as a Binance Coin trust. If you want to own crypto in your brokerage or IRA, you can check out these products. Go to their website, ospreyfunds.io. We do appreciate them sponsoring this show. And with that said, let's go ahead and kick it off. Who wants to go first?
Yeah, I can go first. Welcome to episode numero uno of Investing with the Boys. So a little background on myself. If you guys aren't aware of me on Twitter, my ex is Stock Savvy Shy. I use that as my Batman kind of alter ego. My real like Bruce Wayne job and experience is in corporate strategy. I've worked in tech, healthcare, entertainment, investment banking. My experience has always been digesting data, creating a narrative that is presentable to the leadership so they don't have to do all the nitty gritty. And I've always had a knack for that. I don't know. I wish I was able to do it. I wish ChatGPT came earlier in my career, not just like recently, because my life would be way easier. I started kind of posting on X in 2023, mainly driven by my then girlfriend, now fiance, was sick of me hearing me talk about stocks all the time. She was absolutely just like bored. She's an artsy person who like went to college at OC for art, and she's just an artist, model, She's just like in that world, not in finance. Like she believes in girl math. She does not actually believe in real math. So I started following Fintway like back in 2020, obviously when like the market just took off. Like I was just like glued to Twitter because the moves every single day were just like pure entertainment. Like we had a lot of personalities out there that like also did what I did in my real life. They did on Twitter. They created some kind of narrative on what the movements were, and it was like really entertaining. So I became a follower that way, and then I decided to participate in 2023, and now we're here. So I'm excited to be here, and I'm gonna popcorn it off to Logical.
Yeah, so I am a data scientist by trade. I work at a publicly mid-cap company. I have a lot of experience in the past. I actually got my bachelor's degree in computational mathematics from UCLA. I started off doing systems engineering. I used to intern at NASA, Northrop Grumman. Got into some 3D printing startups. I actually worked at Fisher Investments for a while doing back office data analytics. I've worked in advertising companies, I don't know, all sorts of industries. So yeah, nowadays I am actually doing my master's as well at Georgia Tech in data science, but do a lot of stock stuff on the side, managing my portfolio publicly these days, focusing on small and mid-cap companies, trying to make sure that the numbers make sense to me personally. So, sometimes I miss, the stocks that go crazy, but, I got to make sure that the valuations and all that make a lot of sense to me at the same time. So that's about it for me. So I'll
Listen,
pop it over.
you have clean hands because you have no damage from the falling knife. Doesn't matter if you don't have those 5 or 10 extras. You have clean hands.
Yep.
Very nice. Yeah, my name is Sam. I'm my background is mostly in software and computer engineering. For the most part, that's what I've been since straight out of college. I've really been investing for quite some time, probably over a decade, but actually dialing into the fundamentals and really running my models and the charts and everything, probably just maybe 4 or 5 years back. I've had some good wins in my life, and I've actually noticed that the less I paid attention, the better I did in the stock market. But who would have known we would have had a multi-decade bull market since 2008? But for the most part, what I usually look for in terms of investing is I look at the secular trends. Right now, it seems to be the AI theme, but there's really a lot more going on beyond that. I just find the leaders in that industry and I just invest them. And then on top of that, I think about 20% of my portfolio, I do a little bit more active trading. I would say, I think we all had good 2023 and 2024 years. For me, I think 2024 was really, it was really centered around continuing to stay with the themes, but it just seems like we all got really lucky that the bull market continued because we kind of went into 2024 expecting the same thing we're expecting now, where it's not going to be such a good year. But anyways, I started using Twitter pretty heavily, like back in 2023, same time where Shai did. Before that, I didn't really use Twitter that much. Yeah, I guess you can say that was when Elon Musk bought Twitter, turned it into X. It started becoming like a more entertaining space. Before that, it was just like a lot of advertisements and bots. Wasn't really such a huge fan of that. But yeah, here I am today, meeting you fine fellas through Twitter, actually. So let's do this.
So
Awesome.
it's funny, like for all the listeners, like Logical Sam and I, we do live like not that far away from each other.
Yeah.
I think it's 30 minutes on complete different directions, but like it's not that far. You did bring up a good point, Sam. I kind of want to talk about a little. I'm self-reflecting as you said it. Would you say you're more risky in 24 versus 23 and you're getting riskier like as the years are going on? Like for me, I think I was way riskier in 2023 because I thought is way oversold. Like in 2022 was like so ridiculous. 2024, I was like, I think I'm taming it down a bit. I was being more exposed to large cap tech, like Amazon I own now, Tesla I own. Before it was like nothing above 25 bill. Like I just want the risk on. And now in 25, I'm like, I feel like my risk barometer is getting less and less. And I don't know if it's just because the market keeps going up or maybe I'm getting wiser now that I'm 31 years old.
I think a lot of it is wiser. You're kind of reading the sentiment, but also if you kind of think about it, a lot of the stocks that you have owned, because I've actually been following you a lot more than you've known me. I'm actually hiding in your bushes right now outside of your house. But anyway, seriously, no. You've had a pretty large presence posting your portfolio on YouTube. On Twitter all the time, and the stocks that you've owned have appreciated so much and become such a staples in a lot of the secular trends that they're no longer worth 25 billion anymore. Take for example, Palantir. Like, look at the valuation now. It wasn't anywhere near that valuation back in mid 2023. I was quite risky in 2023, and I think I actually outperformed in 2024 versus 2023 because when I started getting very bullish was like around May into July. And that was like right before the S&P tumbled like 10%. So 2023 was like, I beat the market, but I didn't really beat it by a lot. And I dialed in my risk in 2024, but then kind of tapered off toward the end. Now it's like, I'm not nearly as risky. Like I guess the market sentiment is kind of lagging. We kind of jump into the next part where we talk about the macro. Really, since the end of December, everyone's talking about a Santa Claus rally. But if you kind of look back on it, we've actually had the Santa Claus rally since August, right? So by the time the market dipped down like 5% into the end of last year, 2024, people are like, we didn't get the Santa Claus. I was like, yeah, we had like a 30% rally from like the bottom in like August 5th, right? So, I think it was just like a lot of preparation. A lot of people took up some positions, and I would say the general sentiment in the market right now is like no one knows what the hell is going on. I mean, we're recording this today on Thursday, January 16, and in just a few days, Trump is coming to office. Like, do you know what's going to happen? I have no clue what the hell is going to happen. I'm pretty sure a lot of people don't. So, yeah, I would say my risk level is probably like a 3 or a 4 right now.
Well, I also think like the characteristics are a bit different. Like it's totally weird saying this about the stock market because I'm saying something that's so not technical, not fundamental, but the vibe feels way different. Like the like we had an 8% correction in the Qs. There wasn't any kind of V-shape like explosive nature except for obviously on what we had yesterday. But really, it felt different even then. Like today, like we had a rug pull again today that occurred. Like it feels like it's not a guarantee V anymore. It feels like it's lower highs, and then we're kind of retesting prior lows. And I know, Logical, you're really good at telling these kind of signs. So I'm curious what your input is on like this vibe we're in right now.
I mean, well, I'll say a couple things. One, yesterday we ripped on cooler CPI than expected, but in reality, I mean, we're still coming in at 2.9%. That's well above the 2% target. I mean, in reality, right there, we're not going to get a 2%. It's not likely. If we do, that means that probably the economy is breaking to the downside, which you don't want. So I prefer to actually have a stronger economy. And if it means that we have slightly higher than acceptable inflation to go along with it, I think that's better than potentially the alternative. I also don't think, we have a lot of tolerance for pain at this point. So I think we're going to continue to see upside generally in the economy. Go ahead.
Does that change your perspective on small caps then? Because like it feels like if inflation is going to be like stickier at that level, Fed won't cut rates. They're going to hire for longer, and small caps will have that anchor that they've experienced the past couple of years. Like that's my issue right now in my small cap portfolio.
Yeah, that's fair. I would say a couple things to that. One, we got comments today from a Fed speaker that said basically don't count out the March from Waller don't count out rate cuts in March. That said, I mean, these expectations just change week to week, month to month, every data point we get. So in terms of trying to like determine where is it going to be in a couple of months, I mean, they went back and forth all of 2024, right? We went into the year, market was expecting 7. Then it went to 0,
you're right. 7. Jeez, I forgot about that.
1, and then it went to 3, ended with 4. Like it's just too difficult, right?
Don't forget, in September, the market was expecting 1 rate cut, and then just the Friday before, it became 2. Like, no, I hear.
It's going to change a lot. What I would say is like, think about it like this. If you are betting on IWM, like you're betting on small caps as a sector, yes, you need rate cuts to work out. If you're betting on specific sectors that are very rate sensitive, then you do need rate cuts. But what did we see all of 2024? When rate cuts were literally prolonged until September, we still had a ton of small caps, individual small caps that were outperforming very well. So I think that if you continue to be a stock picker in this market, you can probably do okay. And if you look at what the RSP, the equal weighted S&P, has been doing today, basically SPY was flat, but RSP was actually quite green on the day. We've seen probably the worst drawdown over the last year in RSP, just this last drawdown. So, you have a lot of oversold breadth across the market. It is a possible scenario where individual stocks are actually going to bottom before the major indices do. That typically happens in pullbacks in recent past. So, seeing the market, the broad market cap weighted S&P still have some downside from here makes sense to me, but it is possible that a lot of these individual stocks have already front run that. And so for like charts today, and I agree with you. I mean, you called it a rug pull. I don't know if I'd call it a rug pull, but clearly it looks like a lower high. We got rejected at the 50-day on SPY. Makes me a little bit cautious. I actually added some hedges to my portfolio specifically. I got a little bit more defensive. I took out all of my long dated call options that I had, and I said, you know what? I've had a pretty good year already this year. It's only been 2 weeks, but I'm up over double digits, and I'm thinking I don't want to be greedy. I think we've had 2 very impressive years. I want to make sure that I protect the downside, and if I do, I think the upside will take care of itself. So I'm still fully invested. Have a little bit of hedges on. Got a little bit less beta in the portfolio. I'm just ready for whatever happens. And, me, I'm typically, 10-20% on margin as well. So, I've lightened that exposure right now, and I'm willing to take it up if we see kind of a more, a more difficult kind of correction. if we don't and we resume to the upside, then I'll still get aggressive again. But I need to see something play out either one way or the other.
So I do want to, for the listeners, like which industries are affected by that interest rate. It's, correct me if I'm wrong, everyone over here, but it's more solar, EV, industrials, biotech, a lot of the companies who are pre-revenue, small cap world. I forgot what the statistic is, but I think it's like 40 or 50% of small caps have a variable interest rates. So depending on like what the 10-year yield is or 30-year yield, more like 10-year yield, they're gonna make less money on the bottom line just because the interest rate's higher. So that's why when the Fed instigated the rate cuts in September, it was a risk on environment chapter that was going to finally begin after years of the previous regime. And that's what's baffling right now, because a lot of people, myself included, assumed that the floodgate would finally open up on small caps and all these like lagging names who've been sitting on silence for years. And the interest rates will finally go lower and lower in anticipation of aggressive Fed. And I think logically, you might have said this to me, that the tone from the CEO of Redfin on their conference call in the most recent earnings cycle is everything you need to know about the frustration of these industries. Where his name's Glenn, was his I forgot what his name is. He's like, he made some comment about like drinking blood. Like, he is a warrior type CEO. You can tell how excited he was before the Fed cut rates on his earning calls, and then as soon as the most recent one, like in November, you can feel like deflated he was a bit. Glenn Kelman is the CEO. He was deflated because he just doesn't understand like what's occurring on the interest rates, and it's affecting consumer spending like on homes. Like, he's frustrated.
Yeah, I agree. I mean, I think I was excited about the Redfin opportunity, but then I really realized that, well, I think maybe Sam can talk to this a little bit more since he's a bit more macro. But, you know, as soon as the Fed started cutting those rates, the 10-year actually they kind of called BS on the Fed. And 10-year, the bond market's been kind of ripping to the upside. And we know we almost touched 5% recently. Consensus seems like, you know, that's going to keep going higher. I really don't know. I don't have a crystal ball, and I just kind of play it by ear. But yeah, I mean, a lot of these industries are definitely going to be under pressure. You got to think, you mentioned pre-revenue companies, right? Like, think about it. When these money managers do discounted cash flow models or DCFs, they're using, you know, a different discount rate. And so the higher the rates,
the risk-free rate,
the lower the valuations are going to be. So it's going to be a real headwind for equity assets, especially the riskier ones.
So I do want to hear Sam's input, because I think he's going to nail it. He already communicated this to me. So before you answer, Sam, I want to ask you this question on top of what Logical said is, do you think Trump winning bucked the Fed cut rate cycle launching the floodgates? And I think you're going to know why like Trump winning, what caused the 10-year to go up. I'll reveal it to you.
So when you really think about it, a lot of it has to do with the fact that, you know, the market tends to swing the pendulum from one side to another. And we saw what happened in the beginning of 2024. There were like 6 or 7 rate cuts priced into 2024. And we clearly didn't get that. We only got 4 rate cuts. And by the time they did 2 rate cuts, the market was like, oh, this is awesome, we're getting 2 rate cuts. But I think the narrative kind of switched after that, because the uncertainty came from Trump winning, like you were saying. So of the two nominees that were running, Kamala Harris, you guys remember Kamala Harris? I don't know if you guys remember, but anyways, our VP. Anyways, of them two, both of their initiatives, as far as their budget spending for the entire term, Trump was actually around 15 trillion and Kamala Harris is like around 7 trillion. So Trump would actually incur more of an inflationary force by ways of higher government spending through his entire term, and Kamala was actually less. So I think that if Kamala won, we probably would not have seen rates hike as much as they did. But as Trump's presidency started to come more to fruition, which was highly dependent on the betting markets on Kalshi, as soon as it started to look like Trump was going to win, that's when rates were starting to come up. And then once he won, we just kind of saw that trend still going. But usually, on a historical basis, correlating wise, rates or bonds tend to be correlated positively with the risk equity markets, right? So if the S&P goes up, that means bonds goes up, and that means that rates come down. But we saw the other way around. That correlation actually started to turn out a little bit negative. But in my opinion, I made a post about this today, but in my opinion, if you think about rates are going up, a lot of it really has to do with the dollar, the US dollar, right? The US dollar, US dollar, US dollar. Why is the dollar all the way up to where it was in 2022? So Trump is his narrative is that he's going to impose tariffs to increase the revenue from the U.S. government and therefore decrease the debt of the U.S. government by paying down the debt and so on. There's obviously more stuff, but the way the market does that is they try to front run these tariffs because the tariffs are paid in U.S. dollars, right? So if, let's say, I'm country A and I'm trying to import goods to the U.S. and tariffs go higher, that means that in order for you to pay these higher tariffs, I have to convert my currency into US dollars. So I need to sell my currency and buy the US dollars. And the market knew this was coming, so they try to front run it by buying US dollars. The problem, on the other hand, is that when the other countries see the dollar get stronger against their own currency, they have to actually buy their own currency in order to prop it up. Otherwise, like, their entire economic system is going to crumble. And where they get that money from is by selling U.S. bonds, because usually other countries are big holders of U.S. bonds. So they sell those bonds to buy their own currency, and therefore bonds get sold, rates go up. So it's kind of like that cascading effect that occurs that way. But I mean, we saw it. These rates were rising since September, and from September all the way up until mid-December, rates were rising, but the stock market was going up. And then at some point in September, the market's like, this is getting a little bit scary, right? And then the market started to pull back a little bit. Which brings me right back to where we are today, which I totally agree with Logical, is that not just Logical, I agree with both of you guys. I mean, did you see a mega bounce continue and follow through today? I didn't. I don't think it was a rug pull, but at the same time, I didn't see that much volume happen today. I didn't see a lot of stuff go up. Really, the only things that went up today was energy and also speculative small cap stocks.
Do you think it's because it's kind of becoming more of a reality that the strong dollar will be the boogeyman of this upcoming earnings cycle on a lot of the company's guides? Like, it's going to affect like the big tech companies significantly, the strong dollar. Yeah. So like, I think now the market might be pricing in like lighter guides than anticipate in a Trump victory, but only because like nobody really knows what the real tariffs are going to be. Nobody knows
what lighter guides, dude. Like Palantir is almost at all-time highs again.
No, not Palantir. I'm talking the Apples, the Microsofts, like the
They have a lot of global diversified revenue. So whenever they do the FX currency exchanges, they're going to show FX headwinds essentially in those parts of the world. Exactly.
So I think that's the worry. I think right now.
They do report on constant currency, so it won't impact it as much. But the thing is with these mega caps is that they're kind of safe from all this, because like high rates versus low rates, like they borrow or they gain debt or they sell debt, whatever it's called, based on their preferred bonds or their corporate bonds, right? And Apple is like basically just as, I want to say just as risk-free as like US treasuries, right? But like Apple can borrow money at a much cheaper rate than like something like, I don't mean to pick on its first company that comes to mind, IONQ can borrow money, right? Like it's way more impactful for small caps than it is for like a mega cap company to borrow money. That's the reason why all these mega caps have just been flawlessly performing in terms of stock performance and earnings and free cash flow for like the last 2 years. Like they're totally unimpacted by rates. They don't care. Like Google's like, what's $50 billion? It's like nothing, right?
Well, I don't know, man. Look at Microsoft. It's underperforming the S&P.
I also do think Netflix, like, who's reporting their earnings next week, that might be the first tell of like how serious some currency actually could be on their guide, because like they're heavily exposed to Europe, Asia. Yeah, they're very national, and I don't know if they do hedges on their currency. They should if they don't, but some companies don't, surprisingly.
But Shai, when it comes to Netflix specifically, might not be a great one, because right now they're going through such a pivot as a business. Specifically, the increased volumes from the ad tier offering, especially as after we saw like that Jake Paul streaming, like and the Christmas Day streaming.
Oh, you're right.
They're getting into live sports. They got the WWE. I mean, they're doing the ad tier for all, like the revenue growth might actually like eclipse what's going on the FX side, whereas maybe more of a stalwart business like a Google might be a better tell of what those FX headwinds are going to be.
True. It's very true.
Less growth,
I mean,
probably.
What do you?
Yeah,
How do you
I mean,
think
that- I mean-
Netflix going to do next week? Should
Over
I buy
under.
calls or should I buy puts? Tell me.
I mean, here's the thing about Netflix, though. We can talk about Netflix a little. I think they for sure won the streaming war. That was like
Yes.
a question
Oh,
4
yeah.
years
Oh,
ago.
100%.
A lot of people are like, oh, is streaming a commodity? Like, we'll see. They passed that test. They have a moat. Absolutely have a moat. But what's their next growth avenue? Like, they're squeezing the juice on the ad tier. That's
Yes.
only going to go so far. I think the natural elements is obviously going to be in live sports that they're trying to get at right now.
Yes,
But so is
100%.
Apple. So is Amazon.
Well,
So is it going to get into sports betting or is it going to get to gaming next? Like, that's
Well,
what we have to like,
Yeah.
well,
think
Shai, I
about.
have a question for you, right? Like, you like the Trade Desk as a company, right?
Yeah.
So one of the biggest growth avenues for digital advertising is the fact that we still have a ton of radio and newspaper, and like there's a lot of these classic forms of advertising. So I would say that Netflix probably has something similar with cutting the cord. There's still a lot of people in America that are using cable. So there's still like always going to be that natural CAGR in the space. I'm sure we can look into like what that actually is, but
Well, I want to see what
yeah.
their valuation is right now. I haven't even checked right now.
And-
Like, would
and
before looking, do you think it's above or under 50 times earnings
for
next 12 months?
Trade Desk or for Netflix?
No, for Netflix.
I think it's a good question. Maybe around 50. If I was to
50,
guess
Sam,
around
what's
They're-
yours?
Their major growth stock is probably above. Hey, but before you reveal that,
Oh.
actually, I wanted to hand it over to Wolf Financial or EMP to make a shout out to our sponsors.
Yeah, guys, I'm really enjoying this conversation so far. Y'all are really hitting some really good stuff here. But we do want to shout out our sponsor, Osprey Funds. That's at Osprey Funds. If you look for them on X, ospreyfunds.io. One thing that I really like about Osprey Funds, the ability to purchase crypto exposure in a traditional brokerage account. You don't have to deal with some wallet, getting it to an exchange. Where's it at? It's off chain, all this stuff. You can have it right through your brokerage account, even in your IRA. They've come up with two products. OSOL, ticker OSOL. OSOL is a Solana trust that you can own right there in one of those IRAs or brokerage accounts, as well as a Binance Coin Trust, OBNB. So shout out to Osprey Funds. We really appreciate them sponsoring Investing with the Boys.
Awesome. Appreciate that, Emp.
Thank you.
I'm surprised about the valuation on Netflix, actually. It's 37 times next 12-month earnings. However, this is my issue at Netflix. In 2024, which they're going to report next week, the full year, their earnings, GAAP earnings, grew 64%, purely driven by ad-driven accounts. Like, that's like where the bread and butter is going to be. Going forward, it's only going to be 20% year-over-year growth going from there. And the top line growth,
only.
no, but because the top line growth is only 12% growth. So now their margins right now are 22%. So like, again, Rule of 40 score is mainly for software. I'm fully aware of that, but I like to still use it to see the combination. Like Adobe can always be a 40 plus because they're printing 35% free cash flow margins. Netflix doesn't have the luxury of that in their business model because they have to spend so much money on content. It is not a good at business economics.
They pulled back on content. I think they were doing a ton and they were spending a ton and they're making all those crappy movies.
But they'll never produce 30% free cash flow margins, I don't think, like ever. Like their terminal rates, I think 26%, 26 in 2028. So like now, like if they're growing the top line like 10, 12% with only 20% free cash flow margins and the earnings are only growing 20%, I'm asking myself now this question, just looking at the fundamentals, this isn't good enough, in my opinion, right now. They have to do something more than just like the ad tiers. Or maybe there's upside surprise. Like maybe they grow their earnings 40% and there's some lever they can pull, but I don't know.
I think the growth story is still early.
Go for it, dude. Sorry.
No, I was just going to say, I think the growth story is still early. They probably have really high retention. When you think about investing in this company versus the other mega cap tech, like personally, after the numbers you just told me, it sounds like almost a better investment than like Google or something like that. Because
let's see what Google is right now.
I mean, because Google's way cheaper, right? But I think that there's a reason why you're paying for that. I mean, I don't think the numbers. I mean, look, is it expensive? Yeah, of course it's expensive, but they have years of growth ahead of them. I didn't think it. I thought it would have been crazier than the numbers you just said. So, and you still have the ad tier, you still have live sports, you still have, and the thing is that their getting content by getting like licensing for content that already existed. Like how big was the show Suits once it came to Netflix like last year? Everyone was watching it. It's like they don't even need to make content. They could just bring content here. Yesterday I turned on Netflix and the only thing I was thinking was like, this is the only streaming service that I don't have to think, wait, do I still have a subscription? I have never canceled it in like 10 years. Like Hulu, I cancel like every 6 months. I'm like, I finished that show. I don't care. Or Paramount, I'm like, I got my trial. I'm over it. Like, I think Netflix has staying power as well, I'd say.
For
Sam, you
sure.
have any comments?
They're definitely a staple. No, they're definitely a staple. I mean, when I think about Netflix, they got a wide moat, you know, but when it comes to advertising, I think they actually have a much higher RPAC for people who are under the ad supported tier versus the ad free tier. When they did that password sharing policy, they definitely did see a large uptick in the ad supported tier. So they definitely increased the revenue. But now that that's already priced in, well, also on the financials as well, like will their growth slow down and will their margins contract? Because also, if you think about it, Netflix, they got into all these other businesses, right? That costs money and it's not going to bring in as much revenue as they expect because they have that has to ramp up. So will this be a good quarter for Netflix? But when you think about that, in addition, what about these other mega cap companies, right? They increased their spending by a lot, looked great and everything, but like has that revenue returned to their balance sheets as much as they expected, or have they seen the rate of return that they expected when they did spend this capex? Right. I think that's a going thing. I mean, don't get me wrong, that's the going thing every freaking quarter before all these mega caps report, and it ends up being the same story. You know, everyone gets short before the earnings comes out, everyone's caught off sides, the market rallies like another 10-15%. We are kind of setting up for that, but at the same time it's like, dude, we're coming off of like 20+% years. Historically though, the third year is like a low double-digit percentage. And you know, like you're mentioning, logical, when it comes to inflation, actually inflation for every single decade in the 20th century hovered around an average like around 3%. So we're actually around where the average inflation is. And the Fed switched the narrative for like, we're looking for that 2% terminal inflation rate. Now it's like about 2.8, 2.7, 2.9%. Is the market getting used to a much more restrictive policy and still able to chug along just fine?
I think you'd rather have a strong market, strong economy, and a little bit of inflation rather than the alternative, which is like a weak economy, disinflation to a bad degree. You know, some people are always on Twitter and they're like, "Oh, I want deflation." No, you don't. You do not want deflation. We will be in a depression. You'll be out of a job.
First off, like we're going to talk about what's going to be a deflationary environment in a couple of years. Like I think the market's violently underrating how deflationary agentic AI is going to be.
Oh, okay. I see what you're saying. Definitely. Technology is deflationary by nature.
This upcoming, I think everyone always says tech will always be like the cloud, internet, etc. AI is going to turn it upside down, in my opinion. And that's why we're going to talk about AI, the next topic right here, because I think we're all very similar on we're thematic investors. Look for identify secular shifts that are going to affect multiple industries. Clearly, like my first theme that I was really excited about was AI. We saw in 2023, like every revolution, technological revolution, the first focus is always in the infrastructure. You saw it in the .com era. All the attention was on Cisco, IBM, Verizon, AT&T. Like these companies were laying down the groundwork for connectivity. Essential work, 100%. But they weren't the crown jewels of that era. The crown jewels ended up being the online marketplaces like the Amazon that were built on top of the structural arteries.
The internet companies,
exactly. Same thing the Google built on. Same thing's going to happen in this AI era. Like NVIDIA, excluding NVIDIA, because NVIDIA is on every single stage, but every technological breakthrough going forward. But like the ASMLs, TSMs, the Microns, the like every equipment manufacturing company, the semiconductors, like all the hardware companies, the GPUs, servers, compute. That's not going to be the crown jewel of this era. The crown jewel of this era.
Just like back in the day when a lot of those companies were essentially commoditized, you think that's the same thing that's going to happen here?
I think you can make the argument memory is very commoditized for sure. I think hardware is very unique because there's a lot of monopolies within hardware. Like no other company does it, but also there could be a couple dead years where they just don't grow like at all. Because the issue at the phase one of AI is there's a heavy CapEx requirement. That's not going to be recurring. It's always going to be a big tech, or all these customers are going to get as many tools as possible in order to make these AI products going forward. But like, as soon as they get the tools, they're not going to have to keep getting these tools every single year. Like, they can cool off a bit until they need a refresh. And that's why, like, the second stage that we're going to talk about as well is the applications, the software names. This is where, in my opinion, AI gets introduced to permanence. There's no cyclical risk associated with it. And that's why all three of us are kind of centering portfolios around the software space. But before we get to stage 2, I do want to start stage 1 more. But Sam, go ahead.
No, I mean, I was going to add on to stage 1 as well. I mean, I've worked in IT for, which feels like my whole life. I mean, it didn't just start after graduating college. I've been just doing a lot of IT stuff in the site since then. But yeah, I mean, like, you can't build an application without a computer, right? But obviously these companies have computers, but the way that these companies build out their infrastructure, especially when it comes to a lot of the hyperscalers, Amazon, Google, Microsoft, Oracle, and so on, they have to refresh all of their infrastructure about every 3 to 4 years. And it's not because like, oh, this computer's too slow, we need a new one. It's based mostly on the warranty of these. And in order to be compliant, the warranty has to be valid in order to keep it on-prem and working in the entire environment. So every 3 to 4 years, we kind of hit that mark about a couple of years ago, and companies are going through that cycle. But I think that cycle is probably going to come toward an end where the peak CapEx spend and all the new infrastructure is going to end soon. And then that's going to translate over to, okay, let's develop these applications. Let's make sure we're getting revenue on the things that we promised, things we've actually been building out and developing for the last couple of years. And let's see how this goes. And don't get me wrong, like, I've been working with chatbots and LLMs for the last couple of years. I'm not like an AI engineer or anything, but at the same time, like, we've all had this practice. When I say all, I mean like the IT departments in multiple companies. They've had this practice for at least a couple of years. And the last year, these CIOs have really like muscled down. Like, we need to do our AI stuff now, and we need to start making money on it. And it's not just my company. It's like every single company that I hear about across the board, right? So we've already spent all that money. Now it's time to show it up, right? And in my...
Sorry, I just wanted to pause you there and ask you a quick question. Do you think that that's actually going to end up being bullish or bearish for the market? I think that's an interesting thought, because like the CapEx spend is going to stop. Well, I mean, because like the thought is like the CapEx that they're going to stop spending is going to go back to the bottom line of those mega cap companies, right? If they stop spending, and they're the ones that really drive this market. But you know, for the last 2 years, it's basically been an NVIDIA story. But NVIDIA is the one that's going to basically, you know, struggle from that lack of CapEx spend. What happens? How does that net out?
So I think NVIDIA is not going to struggle. I think their CUDA platform just created permanence for them consistently now. But I also want to ask Sam, like, before you answer Logical's question, does TSM guiding for a 40% CAGR in the next 5 years on their AI accelerators change your thought on, is the peak in the near term? Because it sounds like from TSM, which is the visible hand behind the digital economy, everyone needs TSM. They're saying it's going to grow 40% the next 5 years. Like, that's making me think that stage of AI might not be like pausing anytime soon.
I don't think they're going to have any issues. I mean, think about it this way. Most of the TSM manufacturing and the silicon development is done in Taiwan, right? But the Phoenix plant that TSM built out is already online, and they're starting to adopt the manufacturing of much smaller scale silicon, which is mostly put in like smaller devices, computers, and so on. And we haven't even reached that. I don't want to say the iPhone refresh, but the mobile device refresh market, where people are starting to buy more expensive phones and so on. They're hitting that refresh period. I mean, don't get me wrong. Like, my wife has said for years since I forced her to get the iPhone 12 that, like, hey, my phone is totally fine. I don't need a new phone for a while. The other day she ran out of space. She started complaining that you should use the phone. It's like, first of all, delete some stuff off your phone, all right? But anyways, it's going to get to that point. People have to refresh. And when they go for whatever's available, these new products better be cheaper for the companies that are manufacturing so they can expand their margins. I don't think... Go ahead. Sorry.
No, I was going to say, before you continue, like, I do think like that's why there's going to be continuance, because right now there's only web AI via LLMs. Like, there's no smartphone AIs yet. Like, every commentary from like the Qualcomms, even TSMs, like, they mentioned the weakness in smartphones always. I think maybe the baton gets transferred to smartphone AIs going forward, and that might be the next leg for the
Shai,
stage one. Like,
sorry, I just want to quick question or quick thought on earlier you mentioned, I don't want to forget this. You said the 40% growth for TSM and you don't really see any sort of lack of demand moving forward. I agree with that sentiment. But at the same time, if Microsoft shows like earnings, a lack of growth or even negative growth one of these quarters and immediately requires them by shareholders to, cut back that spend, like we're talking about everything's all on the up and up right now. But what happens when we get one quarter where all of these guys underperform, they're down 5, 7, 10% after hours? I mean, do you really expect that 40% to hold?
so I think no. I think AI accelerators specifically, like there's specific niches within TSM that they're gonna benefit from. And I think what for the example you gave, Microsoft, that's purely just like an LLM spend. I think they're just spending money on their LLM, and I think I think we all can agree that is a race to the bottom. I think everything that Meta is doing through Llama is proving that right now, like creating that open source playbook. So I think Microsoft, like, I think that's a great point. Like LLMs, if though that gold rush of dollars goes away from LLMs, will go elsewhere or just return back to the IT budget to figure out where else to take that. That's a pretty big. I think I want to hear Sam's answer to that question because I think he might know more about that in the space. Because I think the IT budget won't ever decrease. I think there's so many lanes within AI to benefit off of. I just think maybe if Microsoft pauses, it's going to take the LLM budget towards something else, maybe Copilot, because Copilot is very underwhelming right now with what they've done with it, or tackle
Yeah.
enterprises because they haven't done much with enterprise innovation in quite a while.
Well, this is the reason why, because I used to have a lot of Microsoft. It used to be one of my top positions, and I started reverse DCAing out of it and just sold the rest of it like around the 440s. And the reason why was because there's one stipulation in the OpenAI contract with Microsoft, and it's on their policies on the website, is that once OpenAI unlocks AGI or artificial general intelligence, Microsoft no longer has the IP for that. Right now, Microsoft has the IP rights to, well, not the IP rights, but they have the revenue share from OpenAI's current AI models. But once they unlock an AGI model, Microsoft is done. They're cut off from that as far as the IP goes. So I think the market kind of figured that out, and that's why they're no longer bidding the stock up, because Microsoft is aggressively investing in their own AI models and trying to catch up with OpenAI. Let's be honest, Microsoft can't touch OpenAI right now. They've invested a lot in them. They had a lot of hope, and then at this point, it's like, how can they possibly catch up when you can already see it in the numbers that are coming out, and especially in terms of the multiple associated with OpenAI's valuation. If you really think about what's going to happen with Microsoft, they have a wide moat, right? They have a lot of Office product suites. They're a hyperscaler and so on. But are they going to be a Wall Street favorite when it comes to AI models? Probably not. And like you were mentioning and alluding to, the Copilot seats have not grown as much as people expected. In fact, they're probably going to start contracting sometime soon because a lot of companies over allocated too many licenses, and now they're cutting back on it because they've realized a lot of people don't actually use these things. So I don't know, man.
Well, what's the future of Microsoft and AI agents? Because I think that's a lever they can pull. That would
Here's
be
the
a
thing.
big saver.
If you want to be in the AI agent space, there's lots of companies that are already executing that space. There's Snowflake. They're already integrating with AI agents. They partnered with, I believe, NVDA for the AI agents development. ServiceNow is already doing that with their entire suite of applications. They've, of course, partnered with NVIDIA. CRM or Salesforce has AI agents as well. Me personally, I wouldn't bet the farm on CRM when it comes to a stock that might outperform, mostly because a lot of companies
they don't innovate. They just acquire because they
they're just doing
creativity.
M&A. Yeah, the growth is inorganic when it comes to that company. But I mean, they'll still be relevant. Like, they're freaking giants still. But do you really want to bet the farm on Microsoft? My opinion, you want hyperscalers, Google and GCP. GCP or Google and Amazon. You want quantum computing, definitely Google. They're the ones who started that. But I mean, you're in a lot of you're a big fan of the quantum computing space, right, Shai? In fact, what would you say the phase 3 for AI is?
Oh, I think the phase 3 of AI is going to be physical AI, 100%. I think you alluded to, like, you heard Jensen speak. I think it caught a lot of people off guard how much robotics or physical AI took out of the keynote speech that he was referencing last week, I think it was. And I think that's something like robotics is not a sci-fi dream anymore. I think what you got from Jensen's like speech was that it's a near-term reality. Physical AI is absolutely here. And in my opinion, I think it might be the biggest TAM of this generation. Like all our lives, generations. Like it's going to be insane just because of the amount of workforce and labor disruption is going to cause. Whoever, it's not gonna be a one man like one company's going to dominate it. Right now, you have NVDA capitalizing on physical AI through their Omniverse platform, where it allows you to design and test robots in their virtual environments. So that's one way of playing it. Second way is I think everyone's aware of Optimus. That's Tesla's approach towards robotics, where they're trying to use real world AI to tackle labor. And that's my favorite play in the space. But then we also have option 3, which is Amazon. They're like quietly leading the logistics robotics when they have, I think, 800 or 750,000 robots right now in their warehouses. And I don't even want to describe the margin expansion opportunity for Amazon on their e-commerce business once physical AI takes off. So like, I think physical AI, and there's also a lot of private companies, which I am so excited for in the coming years to go public. But physical AI is the next derivative of AI. Like we had AI hardware, which was NVIDIA was the king. We had that's stage 1. Stage 2, we had the enterprise AI, which Palantir kicked it off, but there's going to be a handful of names this year that are going to join the party, the Palantir party, and get re-rated. That's going to be 2-3xers. And then we have the physical AI, which I just referenced the 3 names. So I do think that those are the 3 stages of AI, but the next frontier after AI is quantum. So I do want to, I know I'm the quantum bull here, and I maybe and me are more on the risk side of quantum.
I'm not a quantum bear. Like I don't want to make it sound like that, because Logical and I have talked about it too. Like we're not like quantum bears, but I guess I'm sorry to cut you off, but I just want to clarify, we're not bears on quantum computing.
I'm glad you said that, because I do want to also call out that I went overweight on IONQ under $8. So the risk and reward is drastically different than IONQ at $40 right now. Where I knew, or I didn't know, like my style of investing, which I think is good and bad sometimes, where I'd rather be first and wait until the rest of the market realizes it has that FOMO behavior. So like I sat on IONQ while I was stagnating for one-ish years, when it was me accumulating around $8, and I had some opportunity costs. I could probably put it elsewhere, but I'd rather just build a position before it just takes off. So now that it took off, I de-risked, sold half of it at $20 way too early, but I just want to make it all profits so I don't have to think about it. And just, it's a long-term position for me. But I get this question all the time. Like now, like at $40, like, do people buy in? Like, I don't know. Like, I think the Google break, like what you mentioned in Google for quantum, that Willow announcement was an academic breakthrough for the whole thematic. That's like,
it pretty much
that changed like the outlook of decades away to years away. And now it caused all the names in that bucket to get re-rated. And even then, like there's 4 or 5 pure names out there. The TAM of quantum is multi-trillion dollars. These companies combined, even right now, after today's massive move, it's $30 billion combined. So like it's so early, but I don't know. I feel comfortable getting to IONQ at this valuation right now, because it's early. Like being like early in a revolution is going to cause volatility. Like that's the toll you have to pay on being early in any revolution. There's going to be 50, 80% downturns. Like you saw with Amazon, the .com era. Like Jeff Bezos is notorious for that notes when Amazon was down like 60 or 70% that one day. And look where it is now. Like they were just early again, but they experienced that 60 to 80% downturn. I think the same thing will happen in quantum. Like quantum got way ahead of itself a bit for those couple months because of that
And then
re-rating
you
from
hit up
Google.
you hit up Jensen Wong and told him to, you know, say because you sold out of quantum computing. You got to make these.
We'll get to that
push
later.
big.
What Jensen said, because I thought it was so funny.
Yeah.
But I do want to pass it off to Logical because he has looked into quantum a bit, and I'm a bull on the theme. I'm a neutral on the valuation because I would not feel comfortable getting in. For me, even this pullback, I was like, I'd get in at $18 or $20 for IONQ. Like I would not really get in at 28 to 30, even then.
Yeah, I mean, I don't have too much to say on the quantum topic because I'm not really an expert in this. I could talk a lot more about software and specific, like we were talking about that second stage of AI with like Snowflake and the different AI use cases and all that stuff. Like I definitely am way more knowledgeable on that. When it comes to the quantum stuff, look, I think if you can look out 10 plus years, I mean, will this end up looking like you're buying NVIDIA in 2004 or something like that? Maybe. So for that reason, maybe it makes sense to have a small speculative position, probably not after it's gone up 5 to 10x. In these scenarios, you typically see these big hype bubbles. It is a bubble at this moment in time, I would say. I think it's probably best to wait for it to cool off and then maybe start building your position over time, because we all know that like quantum computing from an application standpoint, revenue standpoint, isn't really going to be there for some time. So chasing here at the $40 level, as you said, doesn't really make a lot of sense. Buying and building a position at $8, I mean, that makes sense. Building a small position, de-risking when it runs, maybe adding back when it falls back. Look, to me, I think I'm going to say it. I think it could end up being a better short from this point. And I've shorted these things a couple times in the recent weeks. It's been working out very well. Look, I'm not stupid though. With shorting, you got to be in and out, especially when there's a lot of retail hype. These things can rip in your face. So I'm in, I'm out. Right now, no position. If it runs to a crazy place and I feel like it's exhausting, I might take another short. Again, these are short-term trades. Long-term, I would never hold a short like into something that has such high potential. But clearly right now, I think it is in a bit of a bubble. I'm sure I'll get a lot of hate from people listening on this, but
no, I mean, I think people can agree. Like when you 5x in a matter of 6 months, like that is somewhat of a bubble, especially when there's no real fundamental driver of that except for that academic breakthrough. But does it change your opinion? Like I think IONQ, like Peter Chapman, the CEO, just said last week, like he gave a guide path for the next 6 years, 70% CAGR on the top line, and profitability is going to start occurring in 2027 for them. So
that's insane.
So that's like, okay. So if they're going to hit $1 billion in revenue by 2030, was what she was referencing, and they're going to start having 10% net income margins in 2027, how do you value the stock then? Like feels like that's like my mentality where like something that revolutionary, like quantum computing that can disrupt so many industries. And there's only like, in my opinion, one pure name, maybe two in Rigetti, but really one in IONQ. And the profitability is in 2 or 3 years, and they're growing top line 7%. I'm like,
how do they
only 8 billion?
How do they make their money?
So they make money through like their partnerships with like Air Forces, for example. Like the Air Force gives them like 50 to 60 mil. They have partnerships with AWS and Azure, and they use their actual like solve some problems within those cloud computing companies. And they also like NVIDIA partners up with them. So like NVIDIA is like virtual playground. Like what happens via CUDA, like they partner up with these companies. So I think it's still really early. They obviously only make $42 million this year. That's not much for an $8 billion company. Next year it's going to double, but it's growing. It's doubling every year for the next 3 years. That's the crazy part about it.
That's my problem.
What do they exactly do? Sorry, real quick while we're on this topic, I'll let you go after.
So it's essentially, I won't get too technical, but like it's a trapped ion technology that IONQ uses. It is widely known as the most precise and scalable approach to quantum. It makes you the temperature isn't as sensitive using the trapped ion technology as it is for like a Rigetti or IBM, where I forgot what the temperature is required to use their approach. I'm blanking on the word of what approach they're using. I can pull it right here. Let me see. But
like that's their approach. Like, what are they actually solving?
It's the same thing that AI solving.
It's just faster computing.
It's faster computing.
It's accelerated.
No, but it's not just faster. It's like stuff that theoretically would take years, decades. It takes minutes.
But like, what can you give me like an example of like what would be like a use case that we would want to use quantum for that, obviously AI does not have the capabilities for at this point? or general
things
computing?
that used to be unimaginable. Like think about there's one thing that Google released via Willow. I forgot what it was. Dimensions. Like everyone wondered what kind of if there are different dimensions out there. Google's Willow proved that there is. Like there's like these kind of science fiction type of realities that are finally possible through quantum computing. But like to ask you your real world applications, it's defense. A lot of times, like things are you can get split second decision using quantum computing that you wouldn't be able to get on the
I see.
AI
So it's like,
compute. So like
Everyone looks for faster computing power. I mean, when you think
No,
of
but-
quantum computing versus classical computing can process things at a much faster rate because of the fact that computers are usually just zeros and ones. Like every single bit you see in a computer or a pack or whatever, it's just a zero or it's a one. Quantum computing can have multiple bits inside that single bit, right? They can have a zero and a one. So if you unlock that potential in terms of an amount of packet, or let's say a byte has 8 bits. Quantum computing unlocks more than just not 8 possible options, 2 to the 8th power amount of options. It has more than that. But it can process that same amount of data in the same amount of time. So you're like exponentially increasing the amount of data you can process within an X period of time versus this much in how much classical computing could be. So you're actually able to increase the amount of processing you do without actually increasing or spending a vast budget in improving the infrastructure of the computer itself.
Emp did help with this. I appreciate that. I was blanking on the word, but like IONQ system works in a room temperature. That really is why, like, that's why I was referencing. Like, it's the most scalable and approach towards quantum computing is that because you don't have to go to the absolute zero about negative 500 degrees. Like what's the other ones? Rigetti, I'm blanking on the word again. It's the superconducting qubits that the Rigetti and IBM use. You have to use that at absolute zero. It's essentially space. They work in space.
Yes.
You don't have to use that for IonQ's
it's kind of hard
technology.
to imagine that they're able to do that, without having to have those same requirements. I guess like from a defense perspective, it's like imagine you had to like hack something or whatever, or you had to like solve a puzzle. Yeah, it would basically hack someone's like whatever account in like 2 seconds.
Also, IonQ is trying to build a quantum internet, and they do that via their acquisition of Qubit recently.
Yeah, so you can't. It's not like this is kind of like when you think of different types of language models, ALMs or SLMs or LLMs. It's kind of the same perspective, right? Like if you want to figure out, like the best way to compute, some math problem or something on your book, your computer, if you ask your chatbot that's in your computer or your AI agent, it's not going to go to ChatGPT. It's not going to go to the LLM that OpenAI has and ask for that. It's going to go to a much smaller model with less processing power, so that the amount of cost for you to process that or to pay for that processing is much cheaper than going to like freaking OpenAI to just solve some easy problem. Same for quantum computing. If you're trying to build an architecture of a building and the building is already built, you just need a little bit, like you're not going to use quantum computing to resolve the physics for that. You're going to go somewhere else. You're going to use a smaller model. But if you want to, like, I don't know, create some digital twin model of some building in like this type of industry, whatever, it's like, that's when you use the more sophisticated computing.
Makes sense. So it's just more.
It's also like, I don't know. I see a lot of signs of like a pounce here in the early days, like decades ago, where AI 15, 20 years ago, people were like, that is just a sci-fi dream. There's no world that's going to occur in our lifetime. The way they did it was through government partnership. That's why they're known as a government consultant.
Well, I don't know. I would pause on that real quick because like machine learning has been around for a very long time. I know we throw around AI a lot now, but that's only because we had the ChatGPT moment where it became accessible to all users and consumers on a wide scale. But before that, I mean, data analysts and data scientists and software engineers, machine learning engineers have existed for a very long time.
I don't think at the scale Palantir was doing that, like, finding like an enemy in this specific location, having an AI do that completely. Like that's like where the government defense, like there's probably so many more use cases that I'm not aware of because I don't have that level of clearance. But like there's just like, I agree with you. Machine learning has been around for decades, but I think the scalability of like making a decision for you and you not really having to do much. That's what Palantir was doing. People were like, oh, whoa, that's like something that's not user. They don't have to control at all. It just does it for you. That was like worrisome of people back then. I don't think it was applicable today, but no, you're right. I mean, I just think quantum's going to follow the same playbook
Look,
or IONQ, where it's just me.
I think like the interesting analogy here is just the idea that like it's all about compute, and it's like the bigger and better and faster compute we got, the more things we were able to do. Like for instance, like imagine like I don't know, rare disease detection, cancer detection. You could do a whole genome sequence. I mean, I don't know how long it takes you now with today's compute, but if you had like quantum, it would take less than a millisecond, right? Like, so yeah, it's going to just allow us to do a lot more things. And imagine if you have like healthcare based on, you know, these ways to sequence your genome. I mean, there's just so many applications. So yeah, the more compute you have, the more interesting things we can do. And that's really where we're headed. Yeah, I don't know when that'll actually come to fruition, but like you said, there's already real world applications. Yeah, so that's interesting.
The way I describe it to my future in-laws, because they obviously like they're not in the investing world, so they always pick my brain, and I'm quantum. So I tell them like right now the AI computers, supercomputers, whatnot, it's like driving a car down a straight road. Quantum computing is like a rocket ship just flying through the sky. It's not just faster; it's a completely different way of traveling. That's kind of what it's like. That's my best description I can give for what's like right now with AI and what quantum will be like. And it's really important for like you're laughing.
I'm laughing because like your in-laws are gonna be like, Shy, where should we invest our money? IONQ. Go.
Oh my God.
Let's go.
My fiance went to lunch with her friend. I'm sorry if you're hearing this, her friend. I'm not gonna say the name, but like she saw my fiance's performance in the past year was like 160%. Like I showed you guys. She only owns like 3 or 4 names. One of those names was TMDX from like 2 weeks ago. I think. So I think she invested in TMDX 2 weeks ago, and you just see it
just rip.
Like,
GG.
it's just like tripping down a hill right now.
You know, one sec. Before we go further, I was gonna say, look, you mentioned the rocket thing, and I just wanted to talk about like how I think about like the advancement of compute over time. Like back like 40 years ago or whenever it was, like if it was like the 80s or whatever, you know, you used to have at your company one room with a computer. The entire room was the computer, right? And then if you were an engineer, you'd have to come in with like a whole punched card, and that was like your code. And you process that code. You wait in line with 40 other engineers, and you get one use of that computer. Hopefully, you didn't hole punch the wrong things, and then it processes your code. So before there used to be 40 engineers to like one computer, right? And then over time, the personal computer was created, and then you had one engineer to one computer. And then you built the cloud, and the cloud allows you to have one engineer for multiple computers at the same time. So like it's just crazy how like it all has really just been the advancement and development of compute over time. So I get your point is like, imagine then you had like now I have access to like 10 AWS, you know, servers at the same time. I'm running 5 different models. But could you imagine if they were able to process code at the speed of quantum? I mean, it's just obviously going to get crazier. At this point, like, I mean, I could say this because I've used like legacy databases like Oracles and the Hives and stuff like that. Going from that to like something like a Snowflake, even, I mean, my queries used to take 40 minutes. They became like 40 seconds, sometimes 4 seconds. So like that already, just switching from the legacy databases to these kind of more modern software stacks have already increased compute by crazy.
Dude, this is the reason why I'm so bullish Amazon.
This is the reason. First of all, Amazon just does everything. But like you see every stage, every derivative you just talked about right now, don't you feel like you need the exposure to the next one, which is quantum, just in case it is a reality? Just because like of how transformative it is. That's I think what a lot of investors. That's why a lot of like valuation isn't really much of a concern for a lot of the investors, because like if that next derivative is quantum, which it looks like it's going to be after Google's Willow, valuation taking a side.
Here's what I'll say on that. I think you're right. Look, I just said earlier, like it's a bubble. Look, I do still think that we will be lower when the dust settles. Like imagine next bear market, you know, where is this going to settle? I mean, I don't know if it'll go back to the lows of $8 where you were buying it. And I think it was actually lower than that. If you looked at like the lows, it's probably like $4 or something, if I recall correctly. So I think that when the dust settles, it probably won't get back to those lows that you were seeing, but I think it will be lower than where we are right now. So I think having a long-term spec position makes sense. If we do like, I don't like, I'm looking at $40. You even said, is the risk reward there at this price? Probably not, especially with like a lot of speculation. So, for me, I would actually like to own something like this, especially as the tech is becoming more real. But I don't think I'm willing to pay $40. Maybe I'll look like an idiot, and this is going to be a $400 stock in 10 years. I don't know.
It's gonna hit the teens sometime.
think
I'm
so,
a
yeah.
very big IONQ bull. It's just the way these early movers work. It's gonna hit the high teens. I don't know if it'll, like Logical said, I don't think it'll break single digits ever again, if that, unless their technology is proven obsolete. Trap down technology just doesn't work, which I just don't see that. But be patient. Like, don't go. Even you guys hear how much of a bull I am on IONQ.
Yeah.
Guess what position size it is for me? It's 2% in my growth portfolio. 2%.
But after its rally, so before that, it was
well,
like
I sold
for you.
Yeah. I sold half at 20. Yeah, 20. But like I still maintain, like, I massaged it and manipulated it to be 2% just because it's so early. And all these revolutions we're in right now, let's just say it's a baseball game.
Dude,
AI is in the third inning. We're just getting to the first batting order. Quantum computing stretching before batting practice.
Well,
it's just like so early.
Shai, here's the thing too, right? Like, we're still so early, I think, to the AI narrative because it's just really taking off in the last year or two. So that's kind of where, for me personally, because my style is way more valuation focused. I need to see the revenue and the profit growth and that kind of thing. So for me, it's a better grounds for me personally to go hunting for ideas. That said, though, like, I've read a lot of these books, and like, in terms of, have you ever heard of Michio Kaku? He's like the string theory co-founder. He's like this physicist.
Listen, you're the scholar between us three, because you read it all the time. Like this, you're the more philosophy person.
Well, here's what I'll say.
Like,
he has like a very famous book called Physics of the Impossible, but the other book that he has written is called Physics of the Future, where he basically the whole book is I don't know how long ago it was released, maybe 10 years ago. He interviews academic scientists and researchers at the cutting edge of every single field and how they're what's going to happen in the next 10 years, 30 years, 100 years, or whatever. And they try to give the best prediction. But before he starts the book, he spends 40 pages talking about how in the past, when people tried to predict the future and the technology that's to come, they were always over predicting, or like they were basically saying like,
that.
Yeah. So like, if they were saying like, oh, this thing's not going to be here for 100 years, and then it's there in like 10. So it's like, right now you say, oh, if Jensen comes out and says, quantum's not going to be here for another 15 to 30 years, it's very possible it could be here in 7, right? Like, it's not impossible, is what I'm trying to say.
I saw Back to the Future too. Where's my flying cars, right? This is bullshit. We were supposed to have that like 10 years ago, man. What the hell's going on? No, I hear you. I mean, like, it does tend to happen faster. When you think of technology evolution, it happens on an exponential scale, right? So whatever pace of technology we have, even if you look computing power, it doubles almost every single year. So that doesn't mean that we had half the computing power, 10 years ago. That means we had half computing power a year ago.
Exactly. Yeah, 100%. Yeah, definitely.
We got to talk about what Jensen said about quantum though a little. We just have to, because I think he's
puts print.
No, I just think he's like one of those sneaky friends who, like, he looks like a nice guy, but he's like freaking like alter ego inside. He's playing 4D chess because he said
knows how to play the world, man.
He is, because he was like noticing that the air is getting a little deflated from the AI attention with all his quantum phase.
Yeah.
So you want to like circle back the attention a bit, and also like saying 10, 15, 20, 30 years away. Why are you hiring quantum engineers right now on LinkedIn? Like, if you think it's decades away, why are you hiring people? And then a week later, why are you hosting the first quantum event ever in NVIDIA in March? It was a little manipulation, and I was like, oh, you have a little Elon in you, buddy. I didn't know that.
Shai, it's interesting, right? Well, I mean, he's probably the most important person in tech right now, for sure.
Yeah.
I mean, look, it's a race, right? It's an arms race, just like AI was and is still for all the mega cap tech companies. Could you imagine? I don't know. I mean, obviously you have Google with Willow, but like, if this thing really starts going, I mean, this bull market is just never going to end, because it's just going to be like nonstop CapEx spending to
100%.
the moon.
I mean, if you look back at like 2008, like in 2022, we were not at 2008 levels, but there were plenty of times where people thought, we just had it last year, where people thought the bull market was over, it'd take a big breather, whatever, and it didn't. 2017, the market just went straight up. Like, there was not a single like 2, 4, 5% pullback in 2017. That was Trump's second year in office, right? I'm not saying that it's going to follow that verbatim, but like these things can happen in a bull market, especially when you have a technological revolution we're having today, like with AI. Like honestly, I think the last week was probably one of the first times I've ever like hands-on trained an AI model. And then I was like kind of messing around with it, seeing what it could do. Like it just makes me want to like just go out there and like buy calls on like every single AI stock I could possibly think of. Just
I
like the
agree with you,
potential that
Sam.
these things have. Yeah.
I tried ChatGPT way longer. I don't know why. I was like, I've been using AI machine learning for so long. What's it gonna be? And then I used ChatGPT like like I waited way too long for that, and I was like, damn it. Why? If I knew this, I would have like longed every.
No, I'm not talking about like just ChatGPT or a chatbot.
Right.
I'm talking about actually training an AI model,
No,
right? And I'm not trying to advertise
creating a
AI,
GPT. Creating a GPT,
yeah.
essentially.
But I had to integrate with different services other than just OpenAI. That really it actually helped me save a lot of time in the future for something that I want to do, right? And like. This is like just the base case, you know, but when you have like engineers and whole departments and even whole companies figuring this stuff out 2 years ago, they probably have gotten pretty far today. And we're starting to see this kind of development happen. And we're starting to see AI revenue actually show up on the sheets as of 2 quarters ago and continuing to grow at pretty good rates. Even Andy Jassy said in AWS that their AI revenue is growing at triple digits. Like just I don't know if it's going to stop here, but that's very different from the way the market is going to react to it. Very different.
Dude, I have a friend who's an AI engineer actually, and he's been building his own products on the side. So he's a machine learning engineer by trade, but lately he's been doing a lot of Gen AI, building products using those kinds of APIs and stuff. Dude, he is like trying to build products for his own business, side business, and he's able to develop these softwares in 5 days, which used to take 5 months, 2 years, whatever. He can just build them on the fly. Like, give me this code that does this. Boom, 2 seconds. Boom, done. Like, it's insane.
Which stock are you gonna say, Shai? Which stock?
You're describing why I'm so freaking bullish on agentic AI. Like, or any kind of software any software that's specifically exposed to SMBs, because SMBs are going to generate 10, 100, 1,000x now, because like your buddy mentioned, he doesn't need departments anymore creating these products. Like it's just himself, or it creates this AI agent that's going to be there for like always. So anytime he has a new idea, use this AI agent to create this blah, 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 blah. That's why I'm so bullish on Snowflake and MongoDB, these data infrastructure players, because any software name with a consumption model theoretically should have the golden era in the near term. Like
you're 100% right. And real quick on that, like Meta had notes, Mark Zuckerberg recently, about like they're gonna have layoffs for their underperforming. I think it's just so funny because they're getting ready for this. And I think you're like the consumption based models make a ton of sense, because basically I don't think necessarily that software engineers go obsolete, but instead you're probably going to get like, I don't know, a 60% reduction in staff. Like if you had 5 engineers before, now you have 2, and
queries will 5x. If workforce might reduce 60%, but queries will 5x.
Exactly. So oh my God, I should buy more Snowflake.
This is the reason
that's what I'm saying. Like,
IT budget doesn't go down. You know,
it doesn't.
The only reason why it goes down temporarily is because it's reduced spend and efficient, right? That's the reason why a lot of software stocks have, in my opinion, this is why software stocks, but the consumption-based ones, have pulled back dramatically from their heightened valuations from July 2023, right? Like, I mean, like, has Snowflake seen its 52-week high? Well, I don't even know if it's 52-week high anymore. Remember, Snowflake was like around the 240s levels, and they had that one earnings where Frank Slootman's leaving. And then now we're at like 170, right? But I honestly think that it was not a result of Snowflake. It was a result of contraction in spending. But now, in my opinion, that spending is actually growing, not in the company as a whole, but in the AI department as well as the IT department. That's just my 2 cents. So let's go out and buy calls.
Well, the reason, like,
not financial advice, not financial advice.
I will say consumption models, it is the most cyclical nature of any software companies out there, because we went through a recession for those 2 years in business spending, like those MongoDBs, Snowflakes, even Cloudflare a little with their internet traffic, like Datadog, Confluent, they all struggled. Elastic, they all struggled. But I think we're about, like, we just saw signs of a last earnings cycle all those stocks did really well because they're starting to reflect that Gen AI project revenue flow in their fundamentals. Like I forgot Snowflake. People were the narrative on Snowflake, why it was trapped or stagnating from 120 to 140 for like a year. Everyone was saying AI was going to cannibalize them as a data warehouse company. Data is a commodity. They have no future in this post-AI world. Now it's starting to get re-rated. I think 2025 will be the year that Snowflake gets re-rated to becoming the AI data platform for enterprises. And that re-rating, we've all witnessed firsthand in Palantir how explosive a re-rating could occur if a narrative changes. Like fundamentals. Yeah, go on, Sam.
Well, my question is, and we should probably wrap this up soon, but my question is to you, Shai, and probably to you, and to you, Logical as well. Like, given that near term, I feel like we all kind of share the same sentiment that the market's kind of taking a breather. It's not as risk on as it was for the last couple of years, or as heavy as risk on in this current moment, or even the last month. How do we perceive this, or how do we see 2025 play out? Like, if we're pretty short term, I wouldn't say bearish, but not as bullish in the short term, like what key event is going to happen this year that'll make all of these explode? Because in my opinion, there is no way Snowflake can do a double from here without the market somehow being up 10 and 20%.
No, I think if Snowflake, I think there's a sprint towards software ahead of this earning season in a couple weeks. I think
that soon.
I think there's gonna be a massive revenue reacceleration in a lot of consumption names. I think Snowflake is gonna get 30% this year. Market saying it's 25%. I think their margins bottom for the AI related investments the whole year. So I think the margin free cash flow will start reverting back to 28 to 30%. So Rule 40 score close to 60. I think SBC, which is like Logical agrees with this as well. That's the biggest bear argument on Snowflake. That's going to reduce if there's a revenue reacceleration on the top line. So like, I think you're going to start seeing signs of holy smokes. Software is on fire right now from AI, similar to what hardware was in the beginning of 2023, where you're selling all these hardware companies like, whoa, there's revenue acceleration. Like they're exceeding and guiding up, and every quarter there's continuing to beat and beat. That's going to be software in 2025. And that's why like the names are undervalued, that the market's saying that they're going to be obsolete in the post AI. Like GitLab, your favorite, Sam. I think source code management is going to be such a necessity in the AI world that I think that name that's undervalued right now. Like,
talk my language, baby.
It's going to have a re-rating as well. So like I'm building a GitLab position for that. I might buy some leaps because I do think it's going to be above $100.
Making some call outs.
I do, but it's also a new CEO. So like there's all manipulation on guidance and like conservative, like when a new CEO hops on. But I think we're giving up too much gold for the first episode, guys. Like I think we're exceeding the first hour.
I think
like
we're gonna get to the next level software names. We'll keep it for the
next we have to focus on software next time, because I think we spent way too much time on Netflix, which was not even up for discussion on this.
I didn't even think about talking about Netflix. Like I can't believe we were talking about Netflix for so long. I mean, it was an interesting topic, but it's
that's a great part. Well, this industry, we have so many things we could talk about. We all study all these businesses, and I think like we're gonna get away from it, but it's also good to talk about some of those companies, because it's like, well, you can't talk about like one company in a vacuum. It's all relative too, right? Like, so I think we should have like that perspective of like, well, why are people buying? Why is Netflix at all-time highs while our, maybe a software stock we own is kind of down on the year, right? Like we need to understand what's going on and what's the performance differences there, because the market, has so many things that it can invest in. And clearly people are chasing, or I don't know if they're chasing it, but they're definitely bidding up a name like Netflix right now. So clearly they're doing something right.
We also talk about which stocks will get killed, like Confluent, Datadog. I don't think, and then the market's like deciding that. And that's a hot statement to say before we end the episode, but I'll communicate my bear arguments on Confluence and Datadog a bit next time. And
I'll join you on
that. Is that a teaser for next show? Is that a little teaser right there?
It's still a little balance of pro and bear AI a bit next week.
Yeah, awesome. Great combo, boys. I've really enjoyed it. I mean, getting the introductions from you guys in this first episode, and then you guys just jumping in and going after it, hitting kind of the macro picture of things. You guys hit AI, we hit quantum. I did not expect Netflix either, but it's awesome. You guys are painting kind of that entire picture, and we got a little teaser coming up. So I really enjoyed this first episode, guys. Do you have any closing statements you want to leave with anybody?
maybe there's no lagging time if Netflix adopts quantum in the future. Who knows? There might
Yeah.
no more Ring of Doom if quantum computing becomes a reality for Netflix.
Maybe Netflix announces their earnings ahead of time before we release the episode on Saturday, and the market's up like 10% tomorrow. We'll see.
Yeah, great episode. Great first episode. Looking forward to keep doing these. Thanks for tuning in. Just hand it over.
Hand it over to you,
Yeah.
Em.
Investing with the boys. What a great first podcast episode here. We did the Spaces episode already, but we've got the visual one as well. Going to be an ongoing series. I'm excited to see where this goes next. We do want to shout out our show sponsor, Osprey Funds. OspreyFunds.io is the website. Make sure you check them out, read their prospectus and everything. But we do appreciate them for sponsoring the show. We appreciate all of the boys here. And with that, we will sign off and see you guys on the next episode.